Look, I need you to pay very close attention to what I'm about to show you, because what just happened in the gold market over the past 72 hours is something we haven't seen in over 4 decades, and I'm not talking about some minor technical indicator or a small shift in sentiment. I'm talking about a fundamental restructuring of how the world's largest financial institutions are positioning themselves right now, and if you miss what this means, you could be leaving serious wealth on the table. Let me start with something that happened last Tuesday that barely made the news. The Bank of China, not some small regional player but one of the world's largest central banks, just reported their 18th consecutive month of gold purchases. But here's what's wild. They didn't just buy a little bit. They added 23 tons in a single month. Now, you might be thinking, okay, that's interesting, but why does that matter to me? Because when you zoom out and look at what's actually happening, this isn't just China. Poland added 19 tons. Singapore, a country that historically held almost no gold, just added 26 tons to their reserves. Turkey continues to stack at record pace. And here's the kicker. These aren't random purchases. These are coordinated, strategic moves by central banks who have access to information that you and I will never see. But let me show you something even more revealing. There's this report that comes out every quarter from the World Gold Council, and most people skip right over it because it's dense and technical. But buried in the latest report is a data point that made me sit up straight. Central banks globally have now purchased over 1,100 tons of gold in the past 12 months. That's the highest level of central bank buying since 1967. Let that sink in for a second. 1,967. That was before Nixon closed the gold window. That was before the entire modern fiat currency system even existed. These institutions are buying gold at levels we haven't seen since gold was literally the backbone of the global monetary system. Now, you might be asking yourself, why now? What do they know that we don't? And this is where it gets really interesting, because if you follow the breadcrumbs, a very clear picture emerges. Let me take you back to March of 2022. That's when something unprecedented happened. The United States and European Union froze $300 billion of Russian central bank reserves. Just like that, money that Russia thought was safe, money held in dollars and euros, was suddenly inaccessible. Now, whether you think that was justified or not, isn't the point. The point is that every other central bank in the world watched that happen and had the same thought. If they can do it to Russia, they can do it to us. And here's where human psychology comes into play. Imagine you're the head of a central bank in Brazil or India or Saudi Arabia. You've got hundreds of billions of dollars in reserves, and you just watch the world's reserve currency get weaponized. What's your move? You start diversifying. You start buying assets that can't be frozen, can't be sanctioned, can't be controlled by a foreign government. You buy gold. Physical gold. Gold that sits in your own vaults, in your own country, under your own control. But it's not just about geopolitics. There's something else happening that's even more fundamental, and it has to do with the mathematics of our monetary system. Right now, the United States has $34 trillion in debt. Let me put that in perspective for you. If you started counting to 34 trillion, one number per second, it would take you over 1 million years. That's not a debt that gets paid back. That's a debt that gets inflated away. And every central bank in the world knows this. They know that the only way out of this debt trap is to devalue the currency, to print more money, to inflate the problem away. And when that happens, when the dollar loses purchasing power, what holds its value? Gold. Here's a story that illustrates this perfectly. In 1971, when Nixon closed the gold window and ended the dollar's convertibility to gold, an ounce of gold cost $35. A new car cost about $3,500, so 100 ounces of gold could buy you a car. Today, gold is trading around $2,650 per ounce. A new car costs about $48,000. You know what? 100 ounces of gold still buys you a car. Actually, it buys you 5 cars. Gold didn't go up. The dollar went down. And that's the signal that central banks are reading right now. They're looking at $34 trillion in debt. They're looking at continued deficit spending. They're looking at political gridlock that makes fiscal responsibility impossible, and they're making the rational decision to protect their wealth. Now let me show you something that's happening in the physical gold market that most people don't even know exists. There's this thing called the COMEX, the Commodities Exchange in New York, where gold futures are traded. And there's a specific category of gold called registered gold, which is gold that's available for delivery. Over the past 6 months, registered gold at the COMEX has dropped by 42%. We're talking about millions of ounces that have simply left the warehouse. Where did it go? It went to central banks. It went to sovereign wealth funds. It went to institutions that are taking physical delivery and moving it out of the system. And here's why that matters. The gold market operates on something called fractional reserve, just like banking. For every ounce of physical gold that exists, there are probably 100 paper claims on that gold through futures contracts, ETFs, and other derivatives. It's a system that works perfectly fine as long as everyone's happy holding paper. But the moment people start demanding physical delivery, the whole thing breaks down. And that's exactly what we're starting to see. The ratio of paper gold to physical gold is getting stretched to levels that are mathematically unsustainable. Let me give you a real-world example of what happens when this breaks. In 2011, there was a hedge fund called MF Global. They had clients who owned gold futures contracts, paper claims on gold. When MF Global went bankrupt, you know what happened to those clients? They got paid out in cash at the price gold was trading at the time. They didn't get their gold. They got dollars. And by the time the bankruptcy was settled, gold had moved significantly higher. Those clients lost out on massive gains because they held paper instead of physical. Now, I want to take a quick aside here because this is relevant to a lot of people watching. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs or 401ks, there's actually a way to get physical gold into those accounts without triggering taxes or penalties. I put together a free guide that walks through exactly how gold IRAs work, what the rules are, and how to set one up properly. It's in the description below. No pressure. But if you're thinking about protecting your retirement savings, it's worth understanding how this works. All right, back to what's happening in the market right now. So we've got central banks buying at record levels. We've got physical gold leaving the COMEX, but there's a third piece to this puzzle that ties everything together, and it has to do with what's happening in the currency markets. Over the past 18 months, we've seen something remarkable. Countries are starting to settle trade in their own currencies, bypassing the dollar entirely. China and Brazil just signed an agreement to settle trade in yuan and reals. India and Russia are settling oil trades in rupees. Saudi Arabia, the country that literally created the petrodollar system, is now accepting yuan for oil sales to China. Now you might be thinking, okay, but the dollar is still the dominant reserve currency. And you're right. About 58% of global reserves are still held in dollars. But here's the thing. 10 years ago, that number was 72%. The trend is clear. The world is slowly, methodically moving away from dollar dependence. And every time that happens, every time a country reduces its dollar holdings, they're buying something else. And increasingly, that something else is gold. Let me paint you a picture of what this looks like in practice. Imagine you're Saudi Arabia. For the past 50 years, you've sold oil for dollars, and you've recycled those dollars back into U.S. Treasury bonds. That's been the deal. But now you're watching the U.S. freeze Russian reserves. You're watching the U.S. run trillion-dollar deficits. You're watching political dysfunction in Washington. And you're thinking, maybe I need a plan B. So you start diversifying. You start accepting yuan for oil. You start buying gold. You start building relationships with other countries that are also looking for alternatives to the dollar system. And slowly, the architecture of global finance starts to shift. Here's where it gets really interesting from a market mechanics perspective. Gold has been in a bull market since 2001. We're talking about a 24-year bull market with only minor corrections along the way. But if you look at the chart, something changed in 2022. The volatility decreased. The drawdowns became shallower. The rallies became more sustained. You know what that indicates? It indicates that a new class of buyer entered the market. Not speculators who buy and sell based on momentum. Not retail investors who panic at every correction. But long-term strategic buyers who accumulate on any weakness and never sell. That's the signature of central bank buying. That's the signature of sovereign wealth funds. That's the signature of institutional money that's making a multi-decade bet on gold. And here's the thing that most people miss. When central banks buy gold, they're not trying to make a profit. They're not looking to flip it in 6 months. They're buying it as a permanent reserve asset, which means that gold is effectively being removed from the available supply. It's going into vaults where it will sit for decades, and as more and more gold gets locked away in central bank reserves, the available supply for everyone else shrinks. It's basic economics. Decreasing supply plus steady or increasing demand equals higher prices. But let me show you something that suggests we're not just talking about gradually higher prices. We might be talking about a fundamental repricing of gold relative to everything else. There's this concept in monetary economics called the gold coverage ratio. It's a simple calculation. You take the total amount of gold a country holds, multiply it by the current gold price, and divide it by the monetary base. It tells you what percentage of a country's money supply is backed by gold. Right now, for the United States, that ratio is about 7%. In other words, if you took all the gold at Fort Knox and valued it at current prices, it would cover 7% of the dollars in circulation. Now here's the interesting part. In 1980, at the peak of the last major gold bull market, that ratio was over 30%. And back in 1933, before Roosevelt confiscated private gold and revalued it, the ratio was close to 100%. So the question becomes, if we're moving back toward a world where gold plays a more central role in the monetary system, where does the gold price need to be to restore those historical ratios? If you run the math and you assume we want to get back to even a 20% coverage ratio, gold would need to be trading somewhere north of $15,000 per ounce, not $2,650, $15,000. Now, I'm not saying that's going to happen tomorrow. I'm not even saying it's going to happen in the next year. But I am saying that the structural forces that would drive gold to that level are already in motion. The debt is already unsustainable. The central banks are already buying. The physical supply is already tightening. The geopolitical fragmentation is already happening. All of the pieces are on the board. We're just waiting for the catalyst that makes it obvious to everyone else. And here's what history teaches us about these kinds of moves. They don't happen gradually. They happen in bursts. Gold will trade sideways for months, maybe even years, and then suddenly, in a matter of weeks, it will reprice 30%, 40%, 50% higher. We saw it in 1979 when gold went from $200 to $850 in less than 2 years. We saw it in 2008 when gold rallied from $700 to $1,900 in 3 years. We saw it in 2020 when gold went from $1,450 to $2,070 in just 6 months. These aren't smooth, predictable moves. They're explosive revaluations that happen when the market suddenly wakes up to a reality that was building beneath the surface for years. And I would argue that we're in that building phase right now. The central banks see it. The sovereign wealth funds see it. The family offices and ultra-high net worth individuals see it. That's why they're accumulating. They're not waiting for confirmation. They're not waiting for gold to break to new all-time highs. They're buying now, while the majority of investors are still focused on stocks and crypto and real estate. They're buying now, while gold is still boring, while it's still ignored, while it's still cheap relative to where it's going. Let me give you another historical parallel that I think is really instructive. In the 1970s, there was a period from about 1974 to 1976 where gold went sideways. It had already had a big move from $35 to $200, and then it just chopped around for 2 years. A lot of people who bought gold in that period got frustrated. They sold, they moved on to other investments, and then, in 1977, gold started moving again. And by 1980, it had gone from $150 to $850. The people who held through that consolidation period, who understood the bigger picture, who recognized that the fundamentals hadn't changed, they made generational wealth. I think we're in a similar period right now. Gold has had a strong run over the past few years, and now it's consolidating. It's building energy. It's setting up for the next leg higher. And the people who recognize that, who use this period to accumulate, who don't get shaken out by short-term volatility, they're going to be the ones who benefit when gold makes its next major move. Now, let's talk about what could be the catalyst. What could be the event that takes gold from where it is now to that next level? There are several possibilities, and honestly, any one of them could do it. The first is a currency crisis. We've already seen many versions of this in countries like Turkey, Argentina, and Lebanon, where the local currency collapsed and people rushed into gold and dollars. But what happens if we see a currency crisis in a major economy? What happens if the euro comes under pressure? What happens if the yen, which is already at multi-decade lows, breaks down further? What happens if confidence in the dollar itself starts to crack? In any of those scenarios, gold becomes the safe haven of last resort. The second possibility is a sovereign debt crisis. Right now, interest payments on U.S. government debt are approaching $1 trillion per year. That's more than we spend on defense. That's more than we spend on Medicare. And it's only going to get worse as more debt matures and has to be refinanced at higher rates. At some point, the market is going to start questioning whether this debt is sustainable. And when that happens, when bond yields start spiking not because of inflation but because of credit risk, gold is going to explode higher. The third possibility, and this is the one that keeps me up at night, is a breakdown in the financial system itself. We got a taste of this in March of 2023 when Silicon Valley Bank collapsed, when Credit Suisse had to be bailed out, when the Fed had to step in with emergency lending facilities. The banking system is more fragile than most people realize. It's built on leverage, on confidence, on the assumption that depositors won't all ask for their money back at the same time. But what happens if that confidence breaks? What happens if we see a cascade of bank failures? What happens if people start pulling money out of the system and looking for safety? Gold is the ultimate safe haven in that scenario. And here's the thing. You don't need all three of these things to happen. You only need one. Any one of these catalysts could be enough to send gold significantly higher. And the smart money, the central banks, the institutions, they're not waiting to see which one it's going to be. They're positioning now, before it's obvious, before everyone else figures it out. Let me share one more piece of evidence that I think ties all of this together. There's a company called Sprott Physical Gold Trust. It's one of the largest physically backed gold funds in the world. And over the past 18 months, they've seen record inflows. Billions of dollars flowing into physical gold. But here's what's interesting. When you look at who's buying, it's not retail investors. It's institutions. It's pension funds. It's endowments. It's the kind of money that moves slowly, that does deep due diligence, that takes multi-year positions. That's the kind of buying that marks a major turning point in a market. So, where does this leave us? What's the actionable takeaway from all of this? I think it's pretty simple. Gold is sending a signal right now. It's not a loud signal. It's not making headlines. But it's there if you know where to look. Central banks are buying at record levels. Physical supply is tightening. The monetary system is under stress. The geopolitical order is fragmenting. All of the conditions are in place for gold to make a major move higher. And the institutions that have the resources to analyze this stuff, they're already positioning for it. The question is, are you? Are you paying attention to what the smart money is doing? Are you looking past the noise and focusing on the fundamentals? Are you thinking about how to protect your wealth in an environment where currencies are being debased, where debt is spiraling out of control, where the financial system is more fragile than it appears? Because here's the reality. When gold makes its next major move, it's going to happen fast. It's not going to wait for you to be ready. It's not going to give you time to do your research and make a plan. It's going to gap higher, and by the time you realize what's happening, you'll be chasing it at much higher prices. The time to position is now, while gold is still consolidating, while it's still boring, while most people are still ignoring it. And look, I'm not saying you should put your entire net worth into gold. I'm not saying you should panic and liquidate everything else. But I am saying that if you don't have meaningful exposure to gold right now, if you're not thinking about how it fits into your overall wealth protection strategy, you're missing what could be the biggest opportunity of the next decade. The signal has been triggered. The institutions are moving. The only question is whether you're going to move with them, or whether you're going to wait until it's too late.